So starting out, what is supply and demand? I know a couple of people actually already know what supply and demand is, but supply, okay, how I perceive supply and demand is simple, whereby we have the banks. The banks are the people who actually trade. So we have the banks. We have the banks and the institutions. These guys are the big money in the market. So what they do is, these guys who have the big money, and we're talking billions and billions of dollars, these guys are the guys who are actually, I'd say, in control of the markets, because the market is basically run by algorithms. So once these big money institutions place their orders, that is what runs the markets, not basically the broker or an individual who is trading 10 lots. Those guys also do not run the markets. The markets are run by the banks and institutions who are placing millions and millions and billions of dollars per day, per trade, or and the like. So what these guys do is, the only way for somebody to actually make money is if somebody else loses money. Okay. So for example, if we have somebody, okay, the only way for a thief to actually make money is if he steals from somebody who really has money, because you can't make money off you can't steal from somebody who doesn't have, and you end up getting money. So that's the whole institution. They're literally not robbing the banks, but that's the same analogy that goes into trading as well. So the banks, knowing that they're the ones who are running the institutions and they have the algorithms that are doing that, they will have their positions running, and with every retail trader, you and I included, as we enter the markets and start trading, us not understanding their analogy behind them trading, them placing their orders, we end up losing money, and that's the way that they end up gaining their money. And it's not only retail traders, it's also small funding companies and all that, all accumulated over a period of, I don't know how long. You'll see that that's why you end up having fewer guys. That's why they say that there's only less than 1% of people who actually make money in the markets as a retail trader, because most of us do not understand the flow of money and how the money is actually moving and exchanging hands. So no understanding that, now we go into how can we be able to interpret the markets such that we can know when these guys are actually placing their trades, when they're actually exiting their trades, and when they're actually, when to enter and when to exit, and how to know where they're actually placing their orders. That's where supply and demand comes in. So you can find just a random sketch that I can actually make right now. You'll see that in the event that we're having price drop, give us a drop, okay? Price gives us a drop, a good drop. Then we know that if it is, we can know the difference between an institution placing an order and just orders being filled. So for example, if you see a strong bearish push, or even let's start with a strong bullish push that we've been seeing, let's say on gold, institutions are now placed their orders around this point, okay? When the institutions place their orders here, since they're the movers of the market will push strongly away from the zone or from the area in which they've placed their institutional orders. Now, for us as retail traders, we want to catch this strong bullish move. So what the institutions do is they want to catch us out in these positions that they take. And that's why you end up seeing that despite having a strong push, price will not move in one direction. Price will move in waves. So you'll see price doing, instead of something like this, price will end up doing wave-like movements. So you'll see the fast push, then you see a pullback. This pullback is meant to catch people who actually took buys at this point, because this retracement, no matter how many pips, will catch you out. You will fear that the market is actually going against you. You close your positions over here. Once you close your positions, that is the money you've lost is the money that the institutions have gained. And so they continue pushing the market in that sort of way. And I believe people usually call this break and retest. So you'll see some sort of movements like this, catching people out, then it pushing up, continue doing this same thing until all this phase of the bullish run has exhausted. Now, once this bullish phase has exhausted, we now see price coming back to this level, the level that was initially where they placed their first buy orders. Okay. Now, with us having this original area where we saw this strong push, our expectation is, depending on how strong this push was, if price comes back here, we might be anticipating the same push back up to fill these ranges that we saw here. And this is now basically our understanding, because if we picture this as somebody, let's say, going to the shop and purchasing some items, let's say mangoes. If you're purchasing many mangoes, or if you're in business, you know that you won't collect all your things all at once. You won't purchase all the things you have all at once. What you do is you purchase things bit by bit. So let's say you are ordering for 100 mangoes, and your capacity to hold mangoes is probably 50. That means you'll take your first 50, then you go back and take them to wherever you're taking them. Then you'll come for the next 50, and then you finalize by taking them where they're supposed to be. That's the same understanding with the markets now. So once you understand this basic concept of price will always come back to the level where the institution has actually taken its orders, and you know if price gives you certain confirms around this area, you know that for sure that price will actually push forward to fill the range that the institutions formed on the first push. So with that out of the way, now we move to the second part now. What validates a strong push? Because what you're looking for is a strong push. So if we have, let's say we have point, price has pushed. Let me actually see whether I can open the charts and look for something that might make sense for you guys. So share screen. So let me reset and clean everything up. So let me open GBP USD as an example. So looking at GBP USD at the moment, we can see that we had this push here. This was quite a significant push, because you can see price tapped this area, and then we saw this massive drop. Okay, now this is an example of a place where you know that institutions have taken their orders, because once the big money has actually placed its orders, there's nothing that stops the drop or the rally that is going to be there. Nothing is stopping this, literally nothing. Same case with whatever happened here. Price got to this point, we saw a rally till this point with no stopping at the same time. All we saw was pullbacks at this point, catching people out. All we saw was pullbacks at this point, catching people out. That is now something that shows us that institutions were taking orders here. Can we say that institutions were taking orders around somewhere like, let's say, this area here? We can see that this area was probably profit-taking areas, where when price when institutions were, let's say, saying that the price they want to buy at this point, and they're anticipating that price comes to this point, you can't close all your orders all at once. So what you'll do is, once price gets to this point, you catch out the first phase of individuals who are actually buying at this top. Then you push back the price to that level, catch people out on the second phase. Then as you continue clearing all your orders at this point, now that is the point now where you can see that they've taken all their orders from all their orders, and market continues to wave the same way it was waving. So this is an example. All I was just using this chart is to show you that this is an example of institutions taking their orders. This is another example of institutions taking their orders. This right here, though it might look like it's a small wave, this is institutions taking their orders around this point, even if it's not as strong of a push. Okay, so we've now seen where institutions take their orders, and we know how it looks. Something that can be an example of signifying these guys taking their orders is how has the push away been. So you can see we have 1, 2, 3, 4, 5, 6, 7, 8. We have 8 candles of the same color or of the same type flowing together. At this point, you can see we have 1, 2, 3, 4. We have 4 candles of the same type pushing again into one direction. So that is something that has shown us in the past that is the institutions and their orders. As long as you're seeing good pushes away from a level, that means that we anticipate that once price, let's say, for example, if price comes back to this point, we'd be anticipating that we'd be seeing the same kind of push away from this level. And even if it breaks this level, it might just be something of this sort. Okay, but the whole idea is where we are seeing a strong push, we might see another strong push again. Same case with this area. You can see that we've had this strong push around this area. So what can happen is we might see this, or if we do not see it at this point, this is price will sort of tend to push up towards an area and show that, and catch people out thinking that this is actually a buy phase, and then it will catch people out and then it will drop. But that's basically the understanding. So it's all about you now basing your understanding of where you don't always buy into a bullish phase, or don't always sell, always wait for a pullback, or always wait for price to come to your zone. No, you'll know when to take trades against the trend and taking trades with the trend. So yeah, so now going back to the whiteboard. Okay, are there any questions so far? You can raise your hand and I can unmute you, then you can ask a question. Any questions? Guess not. Okay. So going back to the whiteboard now. Okay, going back to the whiteboard, we can see that now from this point now, let me even just erase this big money and everything. Now we've seen that price the basic summary can be price pushes from zone to zone, right? So let's say we have a bearish phase. We'll see that there's this level. Now institutions give us the drop. Then wherever price now reverses at this point, call this another zone. Okay, price has pushed from zone A, which is a supply, and it's pushed to zone B, which is a demand. So our understanding will be as price drops, it gives us, as price drops, it gives us a supply zone. As it rejects an area and a low, it forms a demand area. So what is our bias of drawing a demand or a supply area? And that is now where we can say the last bullish candle before a drop. So in this case, if we had something like this, that would be, this will be our supply area, this one here. Depending on if it had a, and maybe if it had a wick somewhere, something like that. So that is our, this is our supply zone. Supply zone is basically the last bullish candle before a drop. Okay, and the same, the inverse is true for demand zone. A demand zone is the last bearish candle before a push up. So at this point, you can see that price gave us this push up before it eventually started dropping down. Now, this dropping down can be in many forms, but basically all we're looking for is price to do something like this. Price to do something like this. It's actually really hard to draw on this thing. Now, once price gets to this point, we see the last bearish candle, and then we see the opposite happen, which is this. Okay. Now, something to note is when price is giving us this drop, it's giving us a range. Okay. Between zones, we have ranges. So in this case, we have a range that has been formed. This range, this is the range now. Okay, so price has given us this lovely drop, and then the place that we've seen the rejection, that is the range between this high and this low. Now, knowing that, then that will show us that this is a point of buying if price comes back and touches this zone and then proceeds up. And this is a zone of selling in the event that price comes to this point and then drop. This is what we'd be expecting on both levels now. This is the overall template of what we'd be looking for. In the event price comes to this low, we'd be buying. If to this low, we'd be buying. If price comes to this high, we'd be selling. So now, something to note though is price won't always give you this kind of movement. Price will never always give you this kind of movement where you see the same candle types. Okay, what price will do is price will give you pullbacks in between. So you'll see a drop, then you see a bullish candle. Change the color. See a bullish candle, and then a continued drop. Maybe the same thing happens again. See a bullish, then we see the final phase where price drops. This is normally what the market will give you guys. These levels are meant to catch you guys out, because you'll see what people will do is at these levels of price, people will be looking to sell for continuation, And there are some people who will be looking for price to do this. Price, we've mentioned that price moves from zone to zone. So this is a major zone, this here. This is the major zone. This is a major zone. Okay. Everything else that is here, these are minor zones. And that is something that you need to understand. When price is forming a range, these are levels to look for continuations. Okay. Something like that. But when price has already formed its range, these are levels to look for continuation of the new trend, which is the reversal that is there. So in scenario one, when we've not seen, I can even cover this, when we do not have all of this, when all we have is market structure of something like this, what happens is you'd be looking to see continuation. So you'd wait for price to drop, be waiting for price to drop, price comes back, gives a rejection of this zone here, then we see a drop. Then the same kind of zone, we see it again, form somewhere around another retracement, and we'd be looking if it forms somewhere like here, we'd be waiting for pullback to that zone, and then we take our trends, our trend bias trade at that point with stop loss above the zone, whereby if we have a wick here, it's just above the wick, above the zone. TP is as the trend is continuing to form, so at the lows. That is the case scenario one that most of the people who trade supply and demand actually do. The second one is now the one that I've just talked to you guys about, which is once the range has been formed, don't go out looking for reversals at this point. Because now what you'd be doing is if you take sales at this point, that means that you're anticipating for the range to continue being expanded. You're anticipating break of these lows, of which might not be the case because the price has already exhausted its whole move, and now it's done accumulating orders, and now it's going for a bullish phase. Okay, so once you take sales at this point, what happens is price takes you out. Then you're like, okay, no, there's just that zone. So you come to the next zone, you say that price is at this point, so this is a drop-based drop. So what do? You take your sales, you're taken out. Because you're trading within a range. This is the range that we've been given. These sales are now exhausted. What you're looking for is buys. And that's why you see that in the new thing that I've been doing with regards to supply and demand, what I've been looking for is a break of level, a break of a level, a break of a level. So if I see a break in this level, I'll wait for the pullback, I take the buy. I wait for pullback, wait for the buy, because I know eventually we're pushing back to these levels that were here. Now, the same scenario that was happening here with these zones, with this bullish phase, you might end up seeing a bearish zone at this point, or a demand at this point, and a demand at this point. So you'd be waiting for a pullback to that demand. You'd be waiting for a pullback at that demand area for you to take your orders to actually continue pushing back up. So I hope that makes sense. Any questions? Any questions? Damn. Which time frame do you trade, especially for pullbacks? Okay. Once I've identified my 4-hour range or 4-hour daily range, sometimes it's even weekly, what I'll do is the pullbacks, if it's like the 4-hour and the daily, I'll wait for my pullbacks on the 1 hour. If I'm taking trades on my 15-minute, I'll identify my range on the 4-hour and the 1 hour, such that the 15-minute or the 30-minute will give me will the price will the 15-minute will give me confirms to actually see a continuation to the upside. So the major zones for me personally are usually between 4 hour daily, depending on the time frame that I'm looking to take a trade, because sometimes like you want to take a swing or you want to take an intraday, there's no need of opening your intraday on the 1 hour and looking for a trade on the 15-minute when you're looking for an intraday move. It doesn't make sense. Hope I've answered your question. So which time frame do you use for major zones? I hope that answers the question. Major zone will be plotted on 4 hour mostly. 4 hour gives a clean 4 hour zone. For example, if you look at Euro USD, let me just open up the Euro dollar right now and show you what I mean. Let me open the Euro dollar for you guys to see. I believe I had talked about this on the first Zoom that we had. This is an example, yeah. You can see price is giving us this push, this bullish push, if I may say. Okay. So in this formation of this bullish push, you can see there's this level. So at this point, these are the levels that you'd be anticipating for pullbacks at such kind of levels. And you can see price pushed back here, minor, gave us a push. And this is the daily. And if you look down on the 4 hour, you'll see many zones in between that are actually giving you continuation, because we are still in the process of forming a bullish, we're still in the process of giving ourselves a bullish push. And if I can zoom out, and you can see, we have broken out of this range that was here. This was the initial range that we had, that zone and this low. So this was the range we were playing at. So once price broke out of this range, we are forming a new range now. And what happens is you'd be anticipating for price to get to new levels, like there. The next one will probably be around here. These are the new levels that you'd be anticipating price to actually get to, for you to start knowing that, okay, this range is now complete. Now I'll not be looking for pullbacks, I'll be looking for a break of levels to actually now see a possible downside for the either a retracement or possible. I don't know whether you guys get what I'm saying. Yeah, don't know if you get my question. Okay, I hope I answered the first question, yeah? So how can I try to understand if price after break gonna retrace on a demand that broke? Okay, how can I try to sorry, I was explaining something to do with price and what price is doing. So once price gives us the range, in this case where we've seen this, sorry, we've seen this level here, we've seen this level here. We are seeing levels in the market, and these levels in the market are basically ranges for us. Okay, so once price breaks out of a range, because at this point in time, for example, in this range here, we had this range. Once price got to this level, our anticipation was price will drop and continue dropping until we see something like this. But at the same time, you need to understand what was causing the range to actually form. So if you do your research, you'll actually see that this range was forming because of the trade wars that were going on between USA and China, and people were really scared about the outcome, and so the dollar weakened at this point where we saw these lows. Okay, once price gave us these lows, we actually formed back. So our anticipation coming back here will be the only way that price would actually give us a push continuing to the downside is if we had the same kind of negativity in the dollar for us to actually see a continued downside. But since the dollar was actually, but since we've had this, this was not the case, whereby we didn't have any sort of like pending news with the dollar. Kindly mute yourself. Kindly mute yourselves, yeah. So at this point, right now this is now the area in which Corona has now got it. Corona entered the chart at this point, okay? Here we see America now having the loss of the currency was actually losing its strength at this point, because you can see this is euro against the dollar. So the dollar weakening means the whole pair is actually going to give us a bullish push. So this is as a result of so many fundamentals, and now we are seeing price give us excessive pushes to the upside into a new range. The range is this one and possibly this one, but I'm probably seeing, yes, we might see a retracement, or we might see a continuation, you never know. But that is the whole idea. Once price gets into a new range, that means that you have more room to actually look for continuations. So you can see, like at this point, you can look for, we saw continuations over here on Monday and Tuesday, whereby price got to the, if I can erase it, if I can clear everything and show you what happened this week. You can see that as price, and I actually talked about this, price gave us this zone right before the week ended last week, and we've seen price come, tap and reject this level, and so our anticipation would be, okay, fine, if price is actually giving us a rejection of this level, then the only thing we'd be anticipating now is price to actually push up and fill this range. If price continues to break this high and proceed upwards, then we'd know that price possibly has more room to actually push until we get to this level here, which is our new range, before we possibly see a reversal towards the low, this range low. Okay, then now we can see what will happen next at that point. That's basically the whole understanding of whatever is happening. The only problem is with the current fundamentals with the dollar, which is the news, and there's so much news, there's so much negativity in the dollar, and so many fundamentals are coming into play. We might see some choppiness in the market, but at the same time, price is always going to push in that sort of way, which is forming of a new zone and giving us a new range. Then we actually play up. Let me see these questions. Support and resistance flips. Take experience in it. Thank you. So ranges are determined by important key levels on the market. Yes, because if you get into the market during your levels based off just any high and any low that you see. For example, if you just came to the market blindly and said, okay, I'll start drawing my levels, and I'll start by saying, okay, this is a level because we saw price getting here and then price rejected. Oh, there's a big rejection. Then now we're seeing price coming back, price rejecting this level. So there's a price level for us. That's not really a way to actually look at the markets. You actually have to look at high probability areas, because that's what you're actually looking to see in terms of continuations and stuff. So even without going back to the whiteboard, let me explain what you can see on the chart itself. This is the daily, as you can see. This is just going to be a breakdown of what I'm actually explaining. Okay, so price gave us this range. Okay, what happens is, and this is a zone in itself because you saw this market gap. I've mentioned this in I think the first ever PDF I wrote. I think I mentioned something to do with zones or something, to do with gaps. So once price gave us this range, okay, with this strong push away, once price starts coming back to this level, we are now seeing a shift. This is not, we're not here looking for continuations, okay? Price is giving us a shift. And so with this shift, we're seeing that, okay, what is happening is price is taking down these levels of ours. Comes to the next level, breaks the level rather than respecting the level. So somebody who was actually trading SD blindly will come to this level and see, okay, we've seen this, they might not even consider this as a zone, but once they see this demand zone here, they'll say, okay, I'll be waiting for price to close above for me to actually take longs to actually fill this range, okay? But what they fail to realize is the speed at which price rejected this price level. Price shot back down, and then, okay, just a minute. And then we can see once the price range was formed, all we're now seeing is we want price to actually come back down to actually give us a new, to actually fill this range that was here. Okay, and that's why when marking up the zones, I'd mark this level not as an area of continuation, rather it will be an area where I'd be looking for potential drop towards this next zone, and at this point I'd be looking for potential drop until we have filled this range that is here. Same thing, it's okay, how do I put it? It's all something that you understand with being more into the markets rather than just drawing, because at the same time now you'd ask me, okay, if price has now given us this range, so why is it that price got to this price level and then we got a continuation of this area? It's all something that you see sometimes it happens, sometimes it doesn't happen. There are so many other actual factors that actually play a part. Maybe if you look at down to the 4 hour, you'll actually see signs that price will actually accept this zone or reject the zone or actually break the zone, because all you're doing is just breaking levels. And you can see eventually this level was broken and we saw a retest at this point to the T. This same rejection that we'd be anticipating at this level, price eventually gave it to us and we filled this range here. Price came, if you missed this earlier entry here with the break, you found the entry again at this point. The same thing that has happened at this point, we've seen the making of this zone around these highs. So price has given us this new range. Once price gives us this new range, all we wait for continuations until the point where now the range has been formed, and then I will be looking for the break of zones that were formed until we retest certain levels, and then we can now see continuations continuations of that nature. So I hope that makes sense. Let me see if there are any questions. Okay, seems like there are no questions. So yeah, so I think I'll continue. This is I think I mentioned to the guys who are in the Zoom meeting from the get-go. I said I might not talk about everything in this session, but I'll break it down such that we'll have more sessions like this whereby I continue taking things further in depth for people to actually understand. Because knowing what we're doing right now, what I'm showing you guys right now is how the market moves, really, how the market moves, because price is always moving, price is always moving, price is always moving. So what I'm showing you right now is how price is going to move, where price might react from, and all, and maybe what you can do to take points from that, to know when to enter sells, when to enter buys, when not to trade, because there's so much that comes into play. There's so much that comes into play. And maybe for somebody who is asking, might ask, does the same thing apply on the lower time frame? And the answer to this is, yeah, this is the same thing that I might be speaking about on the daily and the 4 hour and the like, is the same thing that will happen even on the lower time frames. So even if you're wild enough to actually trade the 1 minute, because I've seen this happen so many times. Actually, this is the same thing that's happening right now. Okay, price. Let me just show you guys, so that at least you know, are you patient enough to actually take trades on the higher time frame, or do you just want to take lower time frame trades? That's the same thing that happens. Price gives us a range. Okay, price is from initially gave us this range. So at this point, what you're doing is you're looking for a break of structure, break of structure, break of structure, break of structure. Once price gives us this, now at this point, if price was to retrace, it would have retraced to this demand. If price gives a new high, retraces to this level, price retraces to another level, price retraces until it has gotten to its premium price. Remember, it was from a premium price, and so it's going to another premium price. Once it gets to this point, what now we see is, okay, now it got to this point, and it seems like it's not pushing further than this. So the next phase is price to give us a new range, okay? Possibly break a low, or possibly we've already seen a break of this high at this point. Now expansion of the range. Now we're waiting to see an expansion of the range, whereby now this new range will be something sort of like this. So what you do is you still have your zones. So we have this level here, we have this level here, we have this level here. So all you're waiting for is, if you missed a sell around this point, if price had given you a sell signal and you didn't take it at this point, that doesn't mean that you're out of the trade. All that means is, okay, you missed that first entry. So all you'll do is you'll wait for the break, then you take it further. What happens is, once it breaks the next level, okay, once it breaks a level, it's a confluence that it's continuing to form, to expand the range. And so it breaks the next level, all you see is something like this. Price pushes back, price does its thing. Price pushes up, does its thing until it fills the range that is here. And then what we'll see most of the time, even if it's not what has happened here, price will eventually come back up, catch people out, people who are expecting sales at this point to actually feel the thing to the low. Price comes back, but instead of, it'll give you a false signal here. Then as you take sales, pushes up and now expands this range to the higher, to break maybe a high at this point, looking for more premium price around this point, and then the same cycle continues throughout the day, because the cycle is expansion of ranges basically. The Asian session will give you consolidation ranges, and then you can it expands from there into the London session. That price, all you need to understand is price moves in waves. So yeah, that's basically how I'd put it as part one of this whole trading supply and demand. I really hope you've understood something. The next one, probably what we'll talk about, is how to anticipate trades, how to anticipate, to mark up your charts, what timing everything and all. And then eventually, probably the end of next week or the start of the next week, we'll start doing simulation sessions, of which that I believe that will be good. Is actually, I remember I had mentioned that I'm not going to be trading on Thursday. That's why I've not traded. But if I was to be trading this at the times that I'd be trading, and something I had mentioned yesterday, you can see this high that was formed. This is a supply. This is a supply area. Okay. This is a supply zone that we have. Price gave us this push. Now, remember that this area is the daily demand. Hence why there is no need for you to actually sell into a daily demand, because if you take sales going into a demand, you're anticipating that price will actually break, which is now more into gambling rather than doing your analysis. That's why this is not an area to sell unless price is actually broken and we see a candle close on the daily below this level. So if we see a candle close on the daily below this level, we'll know that we'll be waiting for a retest of that area for us to actually take sales. So what has happened is price gave this area a rejection once, twice. So I remember I'd called out these, there are these buys that we mentioned about to fill this range. But now, since we're seeing a rejection of this area with price failing to break these highs and candles closing below this area, that means that the next job for us will be now plotting. Like, let me just do it as I would have done it. We have this zone. Price comes, rejects it the first time. Price comes, rejects it the second time. Now, what has happened the second time is there was this area. There was this sort of poor demand zone that was formed. So a break of this level is what will signify sales for us. As a break below such kind of structure is now what confirms sales to us, because you might get a candle close, like for example what I've just said. We had a candle close initially at this point, but now does a candle close signify a change in trend, especially with the bullish trend that we've been having? No, you need more. You need more break of structures, and so that's what you actually anticipate for. You now wait for price to actually give structures around this point. Then once we see a break of that structure, that's exactly now what you take on the sales now. Same thing I talked about on the GBP USD trade yesterday that I had taken. Same thing that has happened with so many trades that I've taken. That's what you anticipate for. And if you recall, for the people who have actually watched the recap of the last video, you'll see that taking trades here as opposed to here are higher in terms of, are better in terms of confirms, and they end up also giving you higher risk to reward ratios as compared to taking a trade after seeing the first candle break, giving a confirm and taking it from here, as opposed to somebody taking it here and their stop loss is around here and aiming for the same target that is around here. So I hope you guys have taken something from this. I'll see you guys in the next one, probably around Monday or Tuesday. I'll be doing them on, I think I'll be doing them on Tuesdays and Thursdays. Yeah. So Tuesdays and Thursdays, that's how I've done it this week. So I think I'll be doing it on Tuesdays and Thursdays. So be on the lookout. Now I'll just go into questions now. Can apply something on 1 minute and 15:30. Okay, I'm taking the questions. So if you don't mind, I started trading supply and demand 1 year ago. Okay, can apply something on 1 minute and 15-30 minutes to identify a range. Well, it's all at the end of the day, all I'm giving you is I'm giving you a fishing rod to actually go fish. I'm not going to give you 100%. There is no way I'm going to tell you everything that I've learned from the markets, because then it will mean that you guys will actually be wouldn't value the work ethic of actually going back into the charts and checking these things for yourself. So all I'm doing is I'm giving you sort of like template. Go back to the charts and actually see with if a 15 and 30 minute range is actually going to give you good entries on the 1 minute, or will it give you good entries on the 15 minute or on the 5 minute. But most of the time, as I've seen, because I've come from trading the lower time frames, if as long as you draw your ranges on your 15 and 30, most of the time it will actually give you good entries on the 5 minute, which is actually good. Then, do you anticipate liquidity runs or fake out as confirmation for reversals? Do you anticipate liquidity runs? Well, yeah. Like for example, let's see if I can see an example. Let's remember an example that I've seen. Okay. I get what you're saying, but the way I'd interpret that question is a fake out. If, for example, if we saw something of this nature, if we saw something of this, if we saw price at this level, if we saw price give this level a break, but then instead of a retest, it comes back and does something like this. Is that what you're asking, Kelvin? Yeah. Okay. So, yeah. Well, I've taken such trades a couple of times. What usually ends up happening in most of these cases is you see. Let me even actually illustrate what your question is. Let me look for some space here. So we have price doing its thing, right? So price is pushing up, pushing back, pushing up, pushing back, pushing up, pushing back, and all this time it's breaking highs, right? So it gets to the top of our range. Okay. What happens most of the time is, as price gets to the price level itself, it might not touch the level itself. It might get close to the level but not touch it. And so what happens is price rejects this level. Okay. Then for somebody looking for buys, what they do is they get to buys at this point, or even taking buys towards this point. But something you need to realize is in cases where price is, I think the RSI is an indicator that talks about oversold and overbought. But there comes a time when price is too overbought or too oversold. Meaning, if it's overbought, that means, so as in it's pushed too much, and it's now anticipating a pullback, or a strong pullback, or a reversal at that point. So once price gets to our main price level, what price will do is it'll look for a liquidity push and actually tap the area, because as you can remember, it's come to this point. It didn't, there was this range this range here. Okay. This range that was formed here was enough for price to just give us a spike up. And then, as people are anticipating a retest of this area, what happens is it's gotten to its premium price. Okay, once it gets to its premium price, now it's looking for sales. And so what happens is it breaks back into this same range that you've drawn anticipating for continuation. It'll break it, and then all we see now is push back down. And for some individuals, you'll actually realize that when you've seen this happen over and over again, and you've taken losses over and over again, you'll realize that you'll know how this system plays out, and you'll actually be taking your sales at this point, rather than even taking your sales at this point. You'll know that this always catches you out, and so you'll sell at this point, and you'll be anticipating, because price has gotten to your premium level, which is this point here. So I hope that answers your question. Kelvin. Okay, great, thanks. So what do you do when there is a, no problem, what do you do when there is a 4-hour demand into a daily demand? It's a good question, actually. It's a good question. I was supposed to answer that question in the next Zoom, but let me just answer it. When let me draw what you're asking. See whether I've understood your question. So, what do you do when there is a 4-hour demand into a daily demand? So, prices formed this demand probably, and then price pushes back to a 4-hour demand, or what are you saying? Okay, personally for me, even before you actually expound on your question, daily time frames and all are the high time frame levels seem to give strong reactions even if it's not a change in bias. So in trading the higher time frame, I tend to use a more aggressive approach whereby even if it's an intraday and I'm just looking for about 20 to 50 pips, I'd have my pendings at like the lowest, like I've mentioned this, right? Let's say this is the demand zone, right? So if you're looking for buys at a demand zone, you'd be looking to take your buys at this point, right? Now, what happens is on the higher time frame, because we are seeing something like this. What I've seen happen most of the time on the lower it's actually not like that. Price will do something like this. Price will push back up, and then come back down to touch this area. What I've seen happen most of the time is, especially on the high time frame, price will not come to just this level. Price more often than not goes deep into the range. So you might either see a 50% or 100%. Something like on the Euro USD, we've seen a 100%, such that price has gotten deep into the level towards the lowest point before it actually pushed back up. So what I'd do is, if I'm taking buys on the daily, I'm actually supposed to post the Euro USD buys that I took earlier in the morning. I mean earlier yesterday morning. I had buys at this point. Meaning I'm still at the ranges that I've mentioned for you guys are the same ranges that I'm actually on the lookout for. So like this price level. So I took my buys at this point, because if you can actually zoom in, we'll see that price gave us this fake out here. I wouldn't call it a fake out per se, but this was the demand area that we're looking at. But price broke this with this strong candle. Initially, I had sales at this point, and I think I posted this on IG, mentioning that it was trading against the trend, and so it wasn't the best of entries, but I had sales at this point. Okay, then what happens is, no, it was at this point. Yeah, it was at this point. Once I started to see the strong rejection at this point, because you can see this strong rejection that was here, price is sort of playing around in this area. So in this area, you can see you have one lower time frame zone, we have two lower time frame zone, and we have the main one, which is this one. Price came to the lowest lower time frame zone on the 4-hour, which was this level. So this to me will be premium price, but I didn't take these buys at this point. I took buys at this point. This will have been the best one, because we're seeing if price gives us a strong break and a strong break, that means that price can't just break three zones at once. Okay, price can, but price doesn't always do that. So your anticipation will be, okay, price has broken this one, price has broken this one. So the possibility will be this will be too far low for price to continue pushing lower, and price needs a retracement. So I'd be buying at this point into the new range, okay, to fill this. So I took buys. I think let me just look at what point I took the buys. Let me just look right now. But basically, I hope I'm answering your question, Matthew, because here there is a 4-hour demand, and it was also a daily demand, and we are heading into a daily supply zone that is here. So I hope I've answered your question. Yeah, exactly what Kelvin is saying. Yeah, structure within structure is a good sign, because you might end up actually having 4-hour entries with daily targets, meaning that you get more pips. Yeah. So I'll post the trade on IG for you guys to actually go back and look at it. But all in all, I hope you guys have taken something from the meeting. See you guys next week on Tuesday. As always, trading is I'd say 10% understanding the strategy, no, 20% understanding the strategy, 30% risk management, and 50% understanding your psychology. So I'll see you guys in the next one. Feel free to DM me to ask me questions. I'll try to answer to the best of my capability if I have the time. And yeah, see you guys. So, yep. Bye-bye.